All right, welcome everybody to the last gathering of the multifamily housing practice group for Berkshire Hathaway Home Services of the year. I hope you are all doing well and ready for the Christmas season. I don't have a big agenda today other than some market stuff, and if you want me to go over some different things, just let me know. I do know you can start seeing the articles for commercial real estate about the recession that's coming, how banks are pulling back. Brokers are starting to get a little more, their outlook isn't quite as optimistic as it was on the whole. I don't know. I think the recession is coming, but if you've been around for these meetings, I think we needed it. So I'm super optimistic about the upcoming recession. I think it's a good thing. I don't know. I can look. Probably anybody watching the markets to see where they're at right now. I had an alert earlier that everything was down.
They're down about 2.5% across the board.
There you go. That's about right. So that's all good. I still think December is going to be okay. On the whole, December is usually a pretty good month. People are out spending money, whether they can afford it or not, they'll be out spending money. I haven't seen anything change as far as properties. The volume of properties is still slowing. We have seen quite a bit of cash come out of the market, I think, since the last time I talked to you. People are kind of idle. I don't know, I will say this, as far as the availability of flip houses, which my flip houses on the side, there's actually some of that's loosening up where prices are becoming reasonable again on a few of these deals. We actually looked at, I looked at 3 deals this past week. Those are the first 3 I've actually looked at in months, probably close to the whole year, that were worth a damn. Anybody seeing anything different in their market? I know we have people in here from Atlanta to California, up in New York.
Here, this is Clayton. Here in Atlanta, prices are stabilizing. What I'm finding is that a lot of these investors, because of the market, especially on the finance side, and their fear that people aren't going to be able to get loans to buy, they are really lowering their offer prices for flip houses. And that's getting to be a problem for a lot of them. I get tons of calls, not just every week, almost every day. Do you have something? But then they go in there and the slightest thing wrong with the house, they want to discount it 5, 10, 15,000. And sellers are saying bull crap. They don't expect the run up, but they don't expect to have their houses to be stolen from them either.
So that's so this is that interesting period when you're going into a recession and you're going to a down, when values are coming down. This is that period of time where sellers are pushing back and buyers know to wait. That's just a matter of time before sellers, they'll have to go where the market is. You'll see it by the end of the first quarter, especially because what will happen is those who have to sell will lower their price, which will continue. That'll drive everything down as well.
True. But
it's just part and parcel. It all goes together. I mean, the days on market has certainly increased. I'm sure you're seeing that everywhere. I know we're seeing it.
Where are you, Jim?
I'm in the northern Kentucky, greater Cincinnati market. So this would, if you looked on a map where Ohio, Kentucky, and Indiana come together, I live on the Kentucky side of that line.
Okay.
We're kind of middle America. Like we're dead center of everything.
Well, one of the biggest problems that keeps being faced here is there are not a lot of houses to sell, but we still have tons of people moving to Atlanta. And what is helping or hurting, however you look at it, is the fact that rents here have gone, sky high. In many cases, whether it's a residential property or condo house, single family house or whatever, and even some business properties, the landlords are raising prices so high that the people have to move. They have nowhere to go.
Wow. It's yeah. I mean, that's the problem everywhere. So we've had these are things I've talked about for the last couple of years, is where is everyone going to go? Because in a normal housing recession, you would see we should be 10 to 15% vacant in rentals. And we're not.
True.
We are, I mean, in my market, we're less than 5%. So when you have a tremendous rental demand on top of a tremendous housing demand, and if that housing changes and people, if there is a glut of foreclosures, or just say there's an increase, a significant increase, let's say it that way. If there is a significant increase in foreclosures, and we already have pressure on the rental community, the question is, where do these people go? And I don't have a good answer. I think the quickest conversions, I think the developers who are ready to do the quickest conversions on maybe old hotel properties, but I think office properties are going to be an easier conversion than just about anything else, because plumbing will be there. I think you'll see a lot of that. I mean, you got to figure out a place for all these people to go. You're going to have an awful lot of families shacking up together.
We're also seeing it on the investor side for multifamily apartments. We had apartment buildings, complexes, you name it, scattered all over Atlanta. And some of these large investors with tons of money came in and bought them all up. And now our medium-sized to small investors, even for something as small as, say, 20-unit complex, are having to fork over $1 million. And it's kind of drying up business unless you are working with some of these, big folks.
Yeah, yes. So we have seen, I haven't seen REITs go down into those smaller units here around in this market. The smallest I've seen them go is about 80 units. So kind of that, 5 to 75 is still in play for the mom and pop investor, but the prices are all changing. And I can tell you, lenders have also changed. We are having a hell of a time getting 100-unit deal closed, because every time we get to a locked in firm closing and a commitment, a closed commitment from the bank, they come up with another reason not to close. And this has been going on for a month. There's nothing, the buyer's ready, everything's approved. We've gotten clears to close. The latest was we were supposed to close last Thursday, and for whatever reason, somebody wasn't in place where they needed to be. The bank put it off until this week, and the current owner's insurance expired on Friday, and we were supposed to close yesterday. And because that insurance expired, the new lender wouldn't close. I'm not sure why, but that was their excuse. And we've had bank inspections. I mean, it's crazy how much stuff we've had to jump through to get this deal closed. And we're still not closed. I'm hoping like hell it gets signed today. Banks are tightening their buy box. If they know, as rates continue to go up, they know their rate will continue to go up. And the cap rates will have to change. If somebody's buying something today at a 7 cap and they're financing this thing, even if they've got a 525 or a 1025 on it, if they've got a 525, it's going to be difficult to say if the property is going to be worth that in 5 years as far from a cap rate perspective. The rental income, I think, will be there is the good news. Rental income, it may only go up a little bit, but I don't see it going down because of the demand we just talked about.
What are you guys seeing as average interest rates for mortgage investing in the multifamily space?
I can tell you what we're seeing locally is sometimes some of the there's a couple of local banks around here will do low 6s, but the national lenders are in the mid 7s.
Okay.
That's what I've seen. I don't know if anybody's seen anything different.
We're seeing about mid 6s here for local, and yeah, national is higher.
Yeah. Expect that to go up, and that's fine. The interest rate going up isn't a bad thing. As long as they're lending money, I'm good.
I think some of it from a macroeconomic standpoint is that, regulatory pressures have changed a little bit, and they have to keep more cash on their balance sheet from a bank perspective. So some of that is they're still balancing that. I mean, obviously they have to, in order for banks to make money, they have to loan it out, so that they will. It's just they just need to make sure that they're covered from a regulatory standpoint, especially the big national ones.
Sure. I just don't want to. I don't want to see what we saw last time when the CMBS market just shut down. That was
what we're. Oh, sorry.
No.
I just was going to say, out here in the Bay Area, in fact, I've got an investor that may put an offer on a 6 unit. We're out looking at money right now, and it's probably, depending on what year arm you're looking at, anywhere like 5.9 to 6.25 here locally.
Mm-hmm.
What we are seeing, to everybody's point, is definitely underwriting standards have tightened up, and a lot of the banks are asking for deposits. I work with a private bank, and they always like to bring somebody. They're a relationship lender, so they want to bring the person in for more than just a one-off deal, But I'm seeing that now almost across the board as the savings rates and amounts go down. People are, the savings rate's at the lowest now since for many years. They need money, so they're asking, "Oh, you want a loan? Well, we need a deposit." Which is, it's hard to get a down payment and give the guy a deposit sometimes, but that's what some of them are asking for to boost their sheets.
Talk about a deja vu. Well, what about like alternative lending and stuff like that? I mean, I've noticed there's still a lot of institutional cash out there, especially where I'm at in Ithaca, where we get a lot of New York City folks, and we get institutional buyers from New York City and whatnot, buying large complexes and strip malls and things like that. I've seen them going down alternative routes where they're using private lenders and they're using these SoFi type lender. What do they call those? The shadow banks.
Yeah,
I think you'll see more and more of that. I think getting creative and alternative financing, creative financing, get up to par with it, because next year that'll be your lifeline.
Well, that's right. There's still a healthy amount of liquidity out there. I mean, there is a lot of cash sitting on the sidelines searching for yield from a lot of my clients and a lot of the institutional investors I talk to. And say, well, we're just sitting on cash waiting for deals to come up.
Oh, no question. I've been preaching to my client base since July of 19 to get the cash. My clients are holding millions in cash.
Oh.
We've been planning on this for a very long time. COVID delayed everything a year, but this is everything is up to par. Like everything is happening as we expected it to happen. So those that listened, are going to be in a great position to take advantage of the market. That's why I said the recession to me is great news, because this is when we all get to make a bunch of money.
They call that the K-shaped recovery. Some of them, the losers are going to be in one way and the winners are going to be in the other.
Absolutely. And our industry has a bad habit of spreading overly optimistic news about one data point. The industry will grab hold of any one data point that looks positive and get hold of it and say, see, everything's okay. And then they put out, I'm all over social media and I watch this stuff. I even saw one today, but one of them that I saw that's going around social media, one of the mortgage companies is pumping this. If you bought, the home was listed for $450,000, but you had to overpay to $500,000, and you financed, I forget. It was a long, convoluted way of saying the interest rate at 3% gave you a payment of $3,080 or $3,050. And today, that same house, you'd be able to buy it for a little bit less, but in the interest rate at 6.5%, your payment only went up $50. Now, first of all, it violates all truth in lending stuff because they didn't have any disclosures on there at all as far as the terms. And then when you get to the I couldn't come up with a single calculation where any of that worked out. Like, not a single one of those numbers worked out. And in fact, if you punch the numbers in as they presented them on a 30-year note, the difference in payment was more like $153 a month, but it was in the 2000s. I even tried shortening the term. And where it really does, what the funny part about it is, if you come to the point where if you would finance them at 15 years, the difference in payment is like 80 cents. Between like, whether it's 3.5% or 4% interest and 6.5% interest. You would actually end up paying about the same if you just financed it for less term. So you see that the industry, that's that whole, what is that, buy the house and date the rate bullshit they put out now, which drives me insane. Where were you assholes 8 months ago when the houses were overpriced? And then today,
I saw an article yesterday or today where they're already talking about people are already underwater if they bought at the peak, and it's like, right. Well, that if they're gonna, if they just bought and they're gonna sell tomorrow, but if they're gonna be there a while, they're gonna own the units for a while. It doesn't really matter if it's still cash flows.
Being in the industry, we're okay, but if you just bought that thing. There were a lot of people buying real estate, thinking in 30 days it'll go up 20 grand and I'll just resell it. Or, they were going to get a bunch of money in 90 days and they're just flipping out. They're flipping out on houses they live in and they're overpaying. I've seen a ton of it. I seen a guy post an ad today on Facebook and I so wanted to call him out, but I'm going to scratch out his name before I blast him. He put out a statement that says the average homeowner, if you buy a house, in 5 years, you have $180,000 of equity.
Shit.
Where the hell are you buying?
Yeah,
unless you bought that house 3 years ago and got the 2 years of increase that we had, ain't no way in hell that's happening. Because you're not getting it on your mortgage. In the first 5 years, you don't pay down shit. In 10 years, if you look at an amortization schedule, for 10 years from the day you buy your house, you still owe what you borrowed. All you do is pay interest. And if you really want to look at it, that technically it's the first 14 years and like 3 months. Right. You pay more interest than principal. Like, it's insane. People put this crap out there and then, they're a mortgage company, they should know. And because social media and everybody gets on the social media shit and believes it, they end up getting burned. And those are the people that I feel bad for. People just watch this stuff and think, oh, it's okay.
Real estate has never been a short.
No, it's a long term, but the lack of education in the system is pretty bad. And I think the industry is not the best at. The industry isn't always the best at shooting straight. least in my opinion. That's just my opinion. I'm sure one of these days the NER is going to send me a letter and tell me to shut up. Wouldn't be the first group that's ever told me. So I watch one of the websites that I watch a lot, and if y'all don't, I highly recommend, because it's usually pretty good information, is BizNow, BISNOW, biznow.com. There's always really good information on there, particularly with real estate information. They're pretty good on where the market is and what's going on. There's always articles in there, and I highly recommend. I'll post this one, a playbook of getting through a recession. I still believe if you are knowing your value and what you bring to a deal will make it important. If deals start getting scarce, you're just going to have to be prepared to be creative in how you get your deals done. I'm a big equity exchanger, and we talked about this last meeting. And this is just a matter of trading equities. You have to know your client pretty well, and you have to counsel your client. But it's a way to help your client get rid of property at the price they want, and getting something that'll be beneficial to them, and with little to no money out of pocket. And you'll find that when things start getting tough and tight, if somebody, you have owner A over here who has a piece of property that he's struggling with, and he's working with the bank to see if he can't get a way out of it. And he's struggling with it because it's just not his thing, whatever it is. He's taking it as far as he can take it, or he doesn't have the cash to put in it to make it perform, whatever that is. He needs to get rid of this property. And then you have guy B over here, or person B, says, I might have a solution to your problem, but if I'm going to come and solve your problem, I want you to take this other piece of property. Now, the two might not match exactly, and you may have to get a third and fourth person involved to make sure everybody's getting the properties that they want. But in essence, we're just trading. We're trading motivations and trading to, kind of wants and needs more than anything else. It becomes, that side of the business is very people oriented. It's not transactional in the sense that all you're caring about is getting to closing. This is where you want to, you're really trying to get to your, satisfy everybody. It's a everybody wins sort of situation. There's no losers, or it doesn't work out. I've got to find a good way to explain this, as I'm supposed to be giving an hour-long talk on this coming up here pretty soon in February. Do you all, I know up in Ithaca, do you have you ever heard of NiceCar, the New York exchangers? I forget what I know it's called NiceCar. There's a great exchange group up there. They're pretty big.
No, I haven't heard of an exchange group.
Yeah, it's a real estate exchange group. Most markets have one, like most major markets have one. We're one of the few that don't. You can look up, if you go to, hold on, let me see if I can do something without, there we go, screwing up too big here. On the NC exchangers, I'll put this out here for you guys. Hold on. I'm going to put this website in the chat, but you can, yeah. Hold on, I'm looking for the number. There we go, affiliate groups. They're in Arizona, there's 3 in California, 3 in Colorado, Georgia. There's an exchange group, the Association of Georgia Real Estate Exchangers in Atlanta. Indiana, Kentucky is in Louisville, Michigan, Montana, New Mexico. Anyway, I'm going to send you this link. I'm going to put this link in the chat for everybody, and you can go there and see where an affiliate group is to the exchangers. And get involved with, I would encourage you to get involved with an exchange group. If there's one near you, I would highly encourage it. You'll learn a ton. They usually will have CE classes pretty regularly that actually pertain to what we do and not just the regular kind of crap we get. You know, we don't get a whole, as commercial agents, we don't get a whole lot of options as far as continuing ed goes. That actually pertains to us. But that is a place where the resources will be very beneficial to you. I have a, here, let me see. I'll send you guys a link to this video as well. There's a video that kind of, it's a good YouTube video. You guys can kind of get an idea of what goes on.
Took that lot in. I don't really want it. Do you want to sell that for me?
Hold on, that's my buddy Alex. So I mean, those are a couple good resources for you guys to take a look at, browse at your discretion. So I haven't seen anybody got any deals they're trying to move, something they need to sell. I know everybody's looking for a good deal. And to that point earlier, when you said you had cash on the sideline and people are looking for a deal, that's, the market is sitting back waiting. And the cash buyers are, at least all mine are. And even the REITs, you know, I go to these, the last exchange meeting I went to was in November, and I might have said it's this last meeting I'm here. Normally we go into an exchange meeting in the last couple of years and you would, Jesus, there'd be $500 million or more in cash available to purchase. And this last meeting, it was about maybe 50 million. And one of my clients was the biggest. And it was, you know, it's a REIT looking, he's not a REIT, he's a syndicator, but they have the money. Everybody was, you know, everybody was kind of stunned, and everybody who would normally be representing people with cash were like, we're gonna wait. We're gonna wait and see what this market does and see what the first quarter brings. I have 2 more exchange meetings in January. One is I think it's the 3rd week of January in Plano, Texas, and then the last couple of days of January and 1st week of February we'll be out in Vegas at the National Council of Exchangers. If anybody's going to be out in Vegas, you can see the dates on that website. We meet in Vegas 4 times a year. If you're going to be around, or if you want to come, let me know. I can get you an invite.
I think as the Fed continues to increase interest rates, all that cash on the sidelines, it gets even harder to spend because you can put it somewhere that has a decent yield.
That's right. Hell, I mean, there's literally, I was talking to one investor the other day. He's like, I think I'll take my 4% in my CD for the next year because it seems pretty safe and my money can just sit there. I'll collect 4% while I wait, then it's sitting idle somewhere else.
Now, if you put it in the market, you would have lost 20% over the last year. So earning 4% feels pretty good.
Right. So there's, you know, high level investing it has a whole, you know, they have a view of this. I finally heard somebody, I post all this stuff. It's so funny. Like I post all this stuff and I sit there and I have Sirius radio. So I usually go between like CNBC, Fox Business, and Bloomberg during the day if I'm in the car. And it cracks me up when things that I've posted and they start doing stories about it. And I'm like, maybe I'm not bragging, but sometimes I think they plagiarize me, but I know they're not because I'm nobody. But one of the things to think about and really look at a large scale. This is the busiest time of year for companies like Amazon. Normally, this time of year, Amazon hires, Jesus, like 50,000 seasonal workers across the country. Not only are they not hiring, they laid off 10,000 people. Think about that. The company that needs the most people at this time of year and laid off 10,000 people. Radial not hiring. The big distribution companies and the big shipping companies that are, these online warehouses. Don't get me wrong, there's always an exception to the rule. If you go to the Amazon website, you'll find a few places that are hiring. I happen to live in a place where we have an Amazon air hub here, and Amazon's not hiring. And 2 years ago, they needed 5,000 people and haven't even hired all of those 5,000 people, and they're not hiring at all. So, I always follow the biggest companies and follow the big, Chase Bank, Bank of America, Wells Fargo, over the summer told all their loan officers to be looking for another job because they're getting laid off October 1st. They know what's coming. There's some things, no matter what the news says, and no matter, you can't listen to that crap. You have to follow the actual actions. So the Fed even came out and, they only raised interest rates 0.5%, but they're reserving the right to go back up because that might not. They're trying to do this soft landing thing, which is fancy language for saying we're going to pull the Band-Aid off as slow as possible. And I'm just not a slow as possible kind of guy, because slow usually means slow. It's less pain for a long time, and I'd rather a lot of pain in a short period of time. As a country, we recover at the same rate. So rather than drag it out, just rip the Band-Aid. But they're not going to do that. And I don't think they'll do that I think they'll make next year purposely painful, because of course everything becomes politically driven as well. And after January, when the seats change for the House, you got a 50-50 cent. Well, what is it? A 50-49 and 1 Senate now. So it's going to be a lot easier to point the finger at one other, the Democrats can point the finger at the Republicans. You'll have gridlock in DC for a while, but one's going to blame the other. And particularly the Democrats will want to blame the Republicans because they're in the White House right now. And they'll say, well, look, we have to do these painful things because the Republicans won't do that. There's always some excuse. It's just how we're built. It's how our system is built. It doesn't, to me, I don't think either one of them serve us very well anymore, but there'll be political motivations to blame the other side so that when the pain comes next year, they can point the finger for the 24 election. That's all. Expect to see that kind of stuff. And again, it's out of our control. I don't pay any attention to it. The only thing I pay attention to is how can we make money selling real estate. Continue to be aggressive in your marketing. Make sure you're out there on social media, probably more than ever. Post daily all across all your platforms and multiple times if you have time. Make sure your face is out there. Make sure you're calling your clients. Stay in touch with your clients, because brokers are going to get really aggressive calling everybody, and that includes your clients. Just make sure you're a top of mind to your client. If you've sold stuff in the last 3 to 5 years, I would be contacting those people just to stay front of mind, because hopefully they're in a position to buy. Watch conditions of properties. This is across not just multifamily, but you can see this across any asset class or even single family houses. Watch on your normal path. You'll see the grass grow. There's opportunity. start going for motivation. And the other big thing when we were talking about flipping earlier, one of the things that's happening here is the bigger the project, the more discount they're going to go for, because everybody, at least in this market, the people that I talk with a lot and the people that are involved with it in the house flipping business, they are taking the as repaired value based on sales of the last 90 days, and they're discounting that 10 to 15%. And that's on a 90-day turn. If it's going to take them 90 days to get this place, turn it and sell it, they're discounting about 90 days is 10%. Anything over 90 days gets a 15% discount. And things that are taken, because we looked at a couple last week, that these were going to be massive 6-month projects. And both the investors I was with that day, including myself, we looked at it and went, there's no way. I can't tell you what the market's going to be in 6 months. It's hard to look that far out right now. Not when you have a market in flux. And there's always going to be, somebody's going to be aggressive and try and get in there and think they can do it. And so what we've done, and what I would encourage you to do if you're working with smaller investors on flips and, the smaller stuff, keep a list of all those houses you want to look at and all those 4 units, all those smaller deals you go to look at that somebody overpaid for. Just keep an eye on those, check in on them every 6 months or so. Because if you overpaid for something here in the last 30 to 45 days, you could find yourself, and especially if you plan on flipping out of it, you could find yourself in a real dilemma come March or April.
Jim, why do you say come March or April? Do you have some thoughts or ideas of what's going to happen in that time?
I think as the recession continues and gets worse, that prices will drop. Probably by the end of March, I would suspect at least 10%. So a lot of these, got to remember, when you're working, if you work with smaller investors at all, and this, they try to use that BRRRR method. You've probably heard of that: buy, rehab, rent out, refinance, repeat. I think that's what it stands for. I know Nate Barger. Great.
That's right.
So in theory, that's great. But when you go to do your refi, that's at 80% of LTV. So if you don't leave yourself some margin on your LTV, and you're basing that LTV on your as repaired value today, and if you lose 10 to 15% of that as repaired value, are you prepared? What are you going to do? You're not flipping it, and if you're holding it, you're losing money. If you have a real potential to lose money there on these skinny deals. I've been watching a guy I went to high school with. I wouldn't say we're friends, we're acquaintances. We went to high school together. I was at the auction two Tuesdays ago. There was a house there. Then this was a relatively quick turn. I think I could have turned it in 30 days. But the number that he was using won't work on the BRRRR. Like I was willing to go up to 98,000 and it would have worked. Like we would have held on to that house. And the ARV on it was 188. He ended up paying 131. It didn't leave you any room. I mean, there's almost no room at all. Like he's going to eat some of that. And even if he sells it, I mean, you put yourself in such a tight margin. He'll make a little bit of money, but the challenge you run into, and so many people have gotten into the business since the last recession, they've never experienced a bank looking at your balance sheet and looking at how you run your flip business. So there comes a time when they start going, you have to maintain at least a 20% profit. Like,
sorry, Jim, where is this? Where in the country is that?
Here in Cincinnati.
Cincinnati. Got it.
Yeah, I'm Northern Kentucky, but I like to say I'm on the good side of Cincinnati in Kentucky. If you've ever flown into Cincinnati, you landed a mile and a half from my house in Kentucky.
Got it. Thank you.
So I just think you have to, pricing is conservative right now. If you're going to a listing appointment, I will tell you, you need to price ahead of the market. If you think a place is worth whatever the property is, it's worth $1 million at a 7.5 cap today. I'd probably tell you, you better list that thing at an 8.5 cap if you want to get it sold, because the buyers are shopping now. The buyers are being picky, and the buyers are going, man, if it's going to take me 45 days to close, and the lenders are doing the same thing. Lenders are not going to be coming in here and lending money on an 8 cap property at 7% interest. That's too narrow. They're not going to do it. At those days, the easy financing, the easy stuff, that shit's over. I think it's gonna be a few years before you see things come back. Hopefully.
What rates are everybody seeing on multifamily deals right now for commercials, 5 units or above?
We talked about that a little bit earlier. If you're using a local
Sorry.
bank, I think most of us are seeing in the mid 6s. If you're using one of the bigger national lenders in those giant deals, probably in the low 7s. I think that's pretty common.
Yeah, that's what we're seeing too. Mid 6s to 7s.
Yeah, that's pretty common. That'll go up. That's it. But again, you got to have a little spread there on your money. You want to have your cash on cash return needs to be double digits. And look, I remember I started in 2001. The standard used to be you had to have at least a 15% cash on cash return. Hell, I had buyers that were a 20% cash on cash return, and that was common. They'd buy in at a 10 cap with the 20% cash on cash return. I mean, from 2002 to 2007, that was pretty common. 15% was more common, but 12% was almost unheard of. Nobody would ever go that low. It's just way too risky. And now you've seen, for the last few years, you've seen a ton of that. I don't think it's good business. So I think you'll see things normalize. I think you want a healthy market. You want a healthy economy. We want interest rates, mortgage interest rates, like home mortgage interest rates, to be around 8%. You want our interest rates to be in that 7-8%. Cap rates on a BB property at 10%, that's good. That is a comfortable place to be. That will reset the market to a position where it should be in. The benefit of that is, look, everybody's savings account actually starts earning interest. Your checking account might even get a little bit. CDs pay. Like when the GDP is at 4 or 5% versus a fragile 2%, those are all good things. Although the economy seemed to be thriving for the last 10 years, it was very unhealthy. A 2% GDP is an unhealthy GDP. That should be higher. It was so fragile, some might even remember, during the Trump administration, we had like a 600-point loss in the Dow Jones one day, and they were so afraid that was going to drive us into a recession, the Fed lowered the rate 0.25% to try to control it. That's fragile. When the bond rating of, we were in the third of the world that actually had a positive bond rating, and it was just over 1%. 2/3 of the world was 0 to negative. Here's what I will tell you the recession is going to happen no matter what, where it is happening. How bad it gets could be determined on policy and if there's a black swan event. And it could also be this whole BRICS thing going on. And I think that could have a pretty dramatic effect if they decide to they decide to replace the dollar as the world reserve, which they're making a pretty brilliant case for it. And keep in mind, what people in our country never seem to think, we don't tend to think outside of our own little world, because in our lives, we've all, we've grown up in a thriving US economy that's always been the kind of the standard bearer for the entire world. We're based so much in debt now that we're really not. And if the US dollar was dethroned as the world currency or world reserve currency, no one would care except us. It doesn't make a difference to anybody except us. I have lots of clients from other countries, particularly Israel. And I've even asked them, they were like, they could care less. It makes no difference to them at all. So that is a real, and if you're not familiar with what's going on with that BRICS thing, look at it. That scares me just about more than anything else as far as our economy goes. That's some scary stuff. I don't know how that looks. I'm sure it'd be painful for a little bit, but I mean, we would recover and we would be fine, but I'm sure it would be painful for a period of time. But it's going to be a great year. 23 is going to be awesome because, as you said, you have a ton of cash buyers. You just have to be you just got to fight every day to do all your diligence to make sure it's going to be getting up early and make sure you're the first one beating the bushes to find the deals, because the buyers are going to buy from somebody. Might as well be you. And that's where I would focus on that. Making sure you're finding the deals.
Where do people think the rates are going to be, say, a year from now, 3 years from now, 5 years from now? Any thoughts? I know it's speculation, but just curious because I'm hearing different opinions.
A year from now. I don't know. I think I know where the top will be, and I think I know where they want to settle. I just don't know the timelines. I think the top will be somewhere between 10 and 12%, and I think they'll settle back at 8%. And I think we'll remain there for some time. That could be. I hope that takes a couple of years to go that high. I really don't. I hope it doesn't go over 10. But I think the goal is to settle back at 8. Because it's just like anything else the government does. They always overshoot on purpose. And then they go back to 8 and go, see what we did for you.
So the rates you're mentioning are your thoughts are on multifamily rates, or is that?
Oh no, that's just mortgage rates, home mortgage rates in general, just kind of as a standard that everybody can kind of refer to.
So you weren't talking about the federal funds rate. You were specifically relating to mortgage.
Yeah.
Okay.
It's usually about a 2% spread, isn't it? Between federal funds and the mortgage rates.
Yeah, out here we've seen actually rates going down a little bit for mortgage.
Sure, we have to.
Yeah.
While things are in flux, you're going to see that.
Yeah, I think we're going to know more at the end of the first quarter, kind of where things are going to head. That's kind of what I'm hearing.
I absolutely agree. I can tell you what the higher ups at Key Bank, I know what they said. They are planning on it topping out at 10% and settling. And now they think it's going to settle back down closer to 7%. Which, okay, 7%, I'd take that, 7-8%. I think those are good numbers. From a macroeconomic point of view, I think those are good numbers.
Yeah, I was quoted on a 5-year ARM, 5.9%. So you kind of shake the dice a little bit and say, well, okay, and in 5 years, The plan would be to refi back out, obviously, and hopefully it's not worse than that. Maybe it could be lower, who knows? Or you take a 7 or a 10-year, pay a little bit more right now and get a little bit more comfort, a little more buffer.
Yeah, I've been encouraging the 10. I just don't know where we're going to be I certainly don't know where we're going to be in 10 years, but I think 5 years is still in play for this recession.
Mhm. Yeah, I see most of my clients all looking at 7-year minimum right now.
Yeah, and I think that's a good move.
Yeah.
The 7 years a good hedge on your. That's a good hedge to what's happening. I think in 7 years you'll be comfortable, like you're going to know one way or the other, and I think it gives you enough time to build a little more just general appreciation.
Right.
So I think that's a really good number to be at on your financing.
Yeah, I think so too. I even use that on my own personal residence.
Yeah,
But I think 7, you have time to deal with, well, out here to deal with the rent control, right? Because we're very limited on what we can raise.
Awful.
So, and half these properties, or maybe even more than half of the properties out here, the owners have been asleep at the wheel for years, and just everything's below market. And in San Jose, it's a straight 5%. That's it. If it's California, it's 5% plus CPI. So, you do your calculation and say, okay, here we are at the starting point. How many years is it going to take me to get there? Do I have some remodeling to do? And 7 years seems pretty comfortable, to get everything done that you need to do by the time you go to refi.
Yeah, I think the one thing I will say, rents have gone up so much in the last 18 months, particularly around here. They're so high. I'm not sure how, like, I don't see that. So to give you an example, last year, well, 18 months ago, between 21 and the first part of 22, rents around here went up $300 a month across the board on everything, just straight up, no matter what you were in. I don't think we'll see that big of an increase, but I think we'll still see some increases next year. But I think after that, it's gonna settle out. I mean, for our market, I know it doesn't sound like much, but $950 to $1,050 a month for a 1-bedroom apartment is a lot of money around here. And I don't know how much higher you can go on that. That's the average, by the way.
Yeah.
Yeah,
Yeah, we've seen, I'm sorry.
No.
We're back at pre-COVID levels pretty much out here in the Bay Area, but it's definitely tapered now. I think we've kind of hit a point, like you say, where at least in today's environment, it's not going to go up too much more from here. I think we recuperated, and I think we're happy for that. But yeah, I don't know if too much more upside.
I agree. Well, I hope this was a good meeting for everybody. We will be kicking things back off in January, and we'll see where everything is and how crazy it is, or maybe it won't be. I don't see that, but I mean, things seem to be going and trending the way we expected. So, get yourself out there. Make sure you're part of the solution for people. That's really, people are going to be having problems. You want to be part of the solution and not just an ambulance chaser. Go out there and get you some deals, and it'll pay off in the future too, because these people remember that you helped them out. And that doesn't, whatever level of an investor you're working with or seller you're working with, it all holds true. People are just looking for someone to help them solve their problem. If you come across a deal and you just don't know, just remember, cash is not the only answer. There's 100 ways to do a deal. I even have a book right here called 100 Ways to Do a Deal. So keep that in mind. Do not get down. Don't think this is, and the people around you, try to keep your teams up. Try to keep the agents around you. Try to keep their spirits up, because a lot of people are going to fall off. They're going to freak out and they're going to fall off. So try to get them to hold on and try to spread the good news, not the bad news, because that's all they're going to hear for a little while. Have a great Christmas, everybody, and a happy New
Merry
Year.
Christmas.
And I will talk to you in January. As always, if you need anything at all, feel free to reach out. I'm always available. I'm happy to help.
Merry Christmas, everybody. Thank you for the meeting, Jim.
Thank you.
Thank you.
Appreciate it,
Great
Carlos.
meeting.
Isaac.
Jim.
talk
Happy
with you,
holidays.
Steve.
Thank you.
Thanks, Pete. Y'all have a great one. We'll talk to you soon.
Thank you, Jim.
All right. Bye-bye.